There are a number of internal control frameworks used as benchmarks. The most commonly used framework in the U.S. is Internal Control Integrated Framework developed by COSO. According to COSO, internal control is a process effected by the entity's board of directors, management, and other personnel, designed to provide reasonable assurance regarding the achievement of objectives relating to operations, reporting, and compliance. Based on the definition, internal control has three objectives. 1. Reliability of reporting. The organization prepares internal and external financial and non-financial reports in conformity with applicable laws, rules, regulations, standards, and internal policies. 2. Efficiency and effectiveness of operations. The organization achieves effective and efficient operations when significant external events can be predicted and their potential effects are mitigated, or the organization understands the extent to which operations can be managed when the effects of significant events cannot be mitigated. The operations category of objectives also includes safeguarding of assets. And 3. Compliance with applicable laws and regulations. When internal control is determined to be effective, senior management and the board of directors have the reasonable assurance with respect to the objectives. Under the COSO framework, internal control can be viewed as including 5 components. 1. The control environment. The control environment is the set of standards, processes, and structures that provide the basis for carrying out internal control across the organization. It may be viewed as the foundation for the other components of internal control. The control environment comprises the integrity and ethical values of the organization, the parameters enabling the board of directors to carry out its oversight responsibilities, the organizational structure, and assignment of authority and responsibility, the process for attracting, developing, and retaining competent individuals, and the rigor around performance measures, incentives, and rewards to drive accountability for performance. 2. Risk assessment. Risk is defined as the possibility that an event will occur and adversely affect the achievement of objectives in the areas of operations, reporting, or compliance. Effective internal control requires that management have a system of risk assessment. Risk assessment is management's process for identifying, analyzing, and responding to risks. 3. Control activities. Control activities are policies and procedures that help ensure that management directives are carried out. 4. Information and communication. The information and communication component of internal control supports all of the other components. 5. Monitoring. Monitoring activities assess whether each of the 5 components are present and functioning. Monitoring may be achieved by performing ongoing activities or by separate evaluations. Ongoing monitoring activities include regularly performed supervisory and management activities, such as continuous monitoring of customer complaints, or reviewing the reasonableness of management reports. Continuous monitoring is often performed with the use of technology, such as embedded software. Separate evaluations are monitoring activities that are performed on a non-routine basis, such as periodic audits by the internal auditors. The principles relating to the control environment component include: demonstrate commitment to integrity and ethical values. The effectiveness of internal control depends on the communication and enforcement of integrity and ethical values. Management should establish a tone at the top of the organization through directives, actions, and behavior that encourages appropriate behavior. Top management should communicate these values through standards such as codes of conduct, official policies, directives, and by example. Individuals should be evaluated for adherence to standards, and deviations should be addressed in a timely manner. Exercise oversight responsibility. It is essential that the Board of Directors establishes appropriate oversight of management and the system of internal control. To do so, the board must collectively possess appropriate expertise and have sufficient members that are independent from management. Establish structure, authority, and responsibility. Management should establish with board oversight, structures, reporting lines, and appropriate authorities and responsibilities. Organizations are structured along various dimensions, such as by product or service, legal entity, or geographic market. Relationships with outsourced service providers may also affect the organization's structure. Organizations delegate authority and responsibility to enable management and other personnel to make decisions according to management's directives. Delegating authority increases risks. Therefore, management should establish appropriate limitations of authority. Demonstrate commitment to competence. Management adopts policies and practices that reflect expectations of stakeholders and provide the foundation for defining competence needed within an organization and the basis for executing and evaluating performance. Commitment to competence is supported by human resource management processes for attracting, developing, and retaining the right fit of management, other personnel, and outsourced service providers. Succession planning for key managers as well as contingency plans for assignment of internal control responsibilities are also important aspects of this area. Enforce accountability. The Board of Directors should hold the Chief Executive Officer responsible for establishing the requisite system of internal control to support the achievement of organizational objectives. Accountability for internal control should be established at all levels of the organization, and it should be supported by appropriate performance measures, incentives, and rewards. The board and senior management must be cognizant of the effects that undue pressure can have on behavior. Undue pressure may cause individuals to circumvent processes or engage in fraudulent activities. The principles related to risk assessment include: These organization specifies objectives with sufficient clarity to enable the identification and assessment of risks relating to objectives. These organization identifies risks to the achievement of its objectives across the entity and analyzes risks as a basis for determining how the risks should be managed. These organization considers the potential for fraud in assessing risks to the achievement of objectives. These organization identifies and assesses changes that could significantly impact the system of internal control. As a part of this process, management must determine how much risk may be prudently accepted, strive to maintain risk within these levels, and understand how much tolerance it has for exceeding the targeted risk levels. A precondition to risk assessment is establishment of objectives that are clear and linked through the organization. After risks have been identified at both the entity and transaction level, a risk analysis is performed, which involves assessing the likelihood of the risk occurring and estimating its impact. Based on this analysis, management determines which risks require a response. Risk responses may involve acceptance, avoidance, reduction, or sharing. Principles related to the control activities component include: These organization selects and develops control activities that contribute to the mitigation of risks to the achievement of objectives to acceptable levels. These organization selects and develops general control activities over technology to support the achievement of objectives. These organization deploys control activities through policies that establish what is expected and procedures that put policies into action. Management develops various types of control activities to mitigate risks, including Authorizations and approvals involves manual or computerized review of the validity of transactions. Verifications involves comparison of two or more items with each other, or with a policy to determine validity or conformance with the policy. Physical controls involves restriction of access to physical assets and performing periodic inventories. Controls over standing data involves controls over data that is used in transaction processing, such as controls over the processes used to populate, update, and maintain the accuracy, completeness, and validity of data in a price master file used to record sales transactions. Reconciliations involves comparisons of two or more data elements, and if differences are identified, actions are taken to resolve the differences. Supervisory controls involves high-level controls to help ensure that other control activities are operating. For example, a review of reconciliation by the supervisor of the individual that performed the reconciliation. In designing control activities, management should consider whether duties are appropriately segregated among different people to reduce the risk of error or fraud. Segregation of duties generally entails dividing the responsibility for recording, authorizing, and approving transactions, and handling the related asset. Segregation of duties helps assure that an individual cannot both perpetrate an error or fraud and also conceal it. Control activities may also be categorized as general controls over technology and transactions or application controls. General controls over technology are control activities that support the reliability of two or more types of transactions or processes. General controls over technology encompass control activities on technology infrastructure which are designed to ensure the completeness, accuracy, and availability of technology processing. General controls over access to technology restrict access to authorized users. And finally, general controls over the acquisition, development, and maintenance of technology and its infrastructure. Transaction or application controls are control activities designed to ensure that particular transactions are accurate, complete, and valid or authorized. Transaction controls are further segregated into input controls, processing controls, and output controls. Input controls includes controls to ensure that the data are input accurately and completely, and transactions are valid or authorized. Processing controls includes controls to ensure that the data is processed accurately. Output controls includes controls over the distribution of output and accuracy of output. The principles related to the information and communication component include: the organization obtains or generates and uses relevant quality information to support the functioning of internal control. Management must design an effective information system, considering the requirements of the users, that reliably captures internal and external sources of data, processes the data into information, and maintains quality throughout processing. Maintaining the quality of information is essential. The quality of information depends on whether it is accessible, correct, current, protected, retained, sufficient, timely, valid, and verifiable. The organization internally communicates information, including objectives and responsibilities for internal control, necessary to support the functioning of internal control. Internal communication is essential to the effective functioning of internal control. To be effective, the information must be communicated through appropriate methods to management, other personnel, and the board of directors. For example, an anonymous whistleblower hotline should be established to ensure that employees and other parties can report inappropriate activity. The organization communicates with external parties regarding matters affecting the functioning of internal control. The organization must also periodically communicate to external parties. Therefore, processes and channels must be established to facilitate communication to parties such as regulators, owners, financial analysts, and customers. The processes and channels should also provide for appropriate communication from external parties such as customers, suppliers, auditors, and regulators to the management and the board of directors. The two principles related to the monitoring component include: the organization selects, develops, and performs ongoing and separate evaluations to ascertain whether the components of internal control are present and functioning. In 2009, COSO issued a guidance on monitoring internal control systems that elaborates on the monitoring component of internal control. Individuals that monitor controls within an organization are referred to as evaluators. Evaluators should be competent and objective in the particular circumstances. Competence refers to the evaluator's knowledge of internal control and related processes, including how controls should operate and what constitutes a deficiency. The evaluator's objectivity refers to whether the person can evaluate the controls without concern about possible consequences of discovering deficiencies. Separate evaluations may be performed by internal auditors, objective evaluators, cross-functional evaluators, or through benchmarking peer against comparable organizations. Self-assessment by individuals within a department may also be used if suitably supervised. In all cases, consideration should be given to the competence and objectivity of the individuals performing the evaluations. The organization evaluates and communicates internal control deficiencies in a timely manner to parties responsible for taking corrective action, including senior management and the board of directors as appropriate. Monitoring includes reporting deficiencies to appropriate personnel, both within and outside of the organization, so that corrective action may be taken. Management should also track whether corrective action is taken on a timely basis. Various classifications of internal controls have been developed to help in the evaluation process, including preventive, detective, and corrective controls, and feedback and feed-forward controls. Preventive controls serve to prevent misstatements from occurring in the first place. Detective controls serve to detect misstatements after they have occurred. Corrective controls serve to correct misstatements after they have been detected. Feedback controls evaluate the results of a process and adjust the process if the results indicate the process is not operating effectively. Feed-forward controls predict results into the future and make changes to alter the projected results. Again, internal control provides reasonable but not absolute assurance that specific entity objectives will be achieved. Even the best internal control may break down because 1. Human judgment and decision-making can be faulty. 2. Breakdowns can occur because of human failures, such as simple errors or mistakes. 3. Controls, whether manual or automated, can be circumvented by collusion. 4. Management has the ability to override internal control. 5. Cost constraints. The cost of internal control should not exceed the benefits expected to be derived from that control. And 6. Custom, culture, and the corporate governance system may inhibit fraud, but they are not absolute deterrents.